great that we're putting all this infrastructure into place for AI. It's just like the telecoms bubble. People were criticizing all of this investment in the telecoms infrastructure, but look at what happened. We're using all of it. It was the right thing to do for the economy, except for the fact that all the people that invested in those things got flushed. There's a tremendous amount of uncertainty, particularly with companies like SK Hynix. SK Hynix has binary tree with myriad paths that it could follow. I was bullish on treasuries because I thought, inflation's overdone. We're looking at these lagging indicators, funds from governments and now from private players in AI, and it doesn't seem to have any limitation.
Today, we have a great conversation with macro investor and AI CEO Chan Sooran. He shares his insights on how understanding how a large flock of birds fly together, called a murmuration, provides clues to determine where the market will move next. He explains how to use volatility to understand why Costco trades at a 43 PE, but SK Hynix trades at 6. We discuss how hyperscalers with strong verticals might have the best prospects in AI and his favorite macro ideas. Finally, he gives the best explanation of what probably happened with hedge fund situational awareness and why Citadel got a 10% discount on listed equities. Chan, welcome to the show. Really happy to have you. I have to tell you that your Substack is literally the first thing I read every day. So I got just a couple of questions to get us started. Why is it called Point Frederick? I'm going to guess it's geography. And how do you get it out at 6:20 in the morning?
Well, I loaded up the night before, so I'll give you the easy
good
answer.
Enough.
It's called Point Frederick because, as you noted, I'm a graduate of the Canadian Service Academy, which is called the Royal Military College of Canada. Actually, there's two. It's the English Language Service Academy. And it's built on a peninsula in Kingston, Ontario, which is roughly halfway between Toronto and Montreal. And that peninsula is called Point Frederick. It was a Royal Navy base in the post-revolutionary era.
I see. So is the Royal Military College, is that the equivalent of West Point or
Yes.
Annapolis for us or something?
Yes, it's actually modeled on West Point. It's a hybrid of West Point and Sandhurst, given its location between
Sure.
Its British provenance and its proximity to the United States. In fact, there is a long-standing exchange of almost 100 years that MacArthur set up between the two service academies. So I was very prominent in debating, and I debated at West Point. There's a big West Point RMC debate every year, but the keystone is the hockey game, which is some of the best hockey I've ever seen, and I've seen a lot of hockey. So,
fair enough. You would know. So why did you start the Substack? It's sort of, I don't know how to describe it. I just find it tremendously useful. It's got really news that's relevant, and there's a good, thoughtful analysis with it. What made you start that, and how long has it been going?
I started it last fall. I wanted to be more disciplined about my personal account. So I'm obviously, focused on my technology company. So I'm not a full-time professional investor as I was. But I was trained in hedge funds, specifically starting when I was at Lehman Brothers in the risk arbitrage group, to spend a lot of time in the morning, very early, going through the news. My first job on the desk, we would have a morning meeting in our group, and the most junior person would have to go through the news headlines for the group, starting with the stories that were most proximate to our positioning. And I maintained that discipline, and I kind of lost it. And I thought, okay, I want to get back more into being disciplined about following the news. And I also wanted to keep myself honest, right? So it's one thing to talk a big game, but I thought if I'm publishing my actual thinking at the time, there are two benefits for me. I can go back and see what I was thinking before and compare it to what actually happened and how I actually behaved to try to measure the discipline in my thinking and my execution. And publishing it and putting it out for the world to see is a way to keep myself honest. So it's a way of putting reputational skin in the game.
I can see that, because when you put something in writing, it sort of concentrates the mind. You have to say something intelligible. It makes you think. And as you say, once you've come out and said it, I always find that I've come out and said this, and now I'm going to be wrong. I'm going to pay the highs, like I did.
You know what, though? I'm not ashamed to pay the highs. because I'm not going to be right every time. But I just want to know that I have a structured, logical framework for thinking. I'm not going to be right every time. I know that, but I want to have like I want the print on the tape,
So
I guess.
what one of the reasons I find it so valuable, and for people who are interested, it's a Substack. It's called Point Frederick Spinnaker. Well worth your time. But one of the things that you've written recently that really resonated is I think you called it murmuration, and I think it's sort of how to pick up changes in the mood and in the wind. It's suddenly, why is the market not focus on something, and all of a sudden it focuses on it for weeks, and then all of a sudden it disappears, or it sort of declines very quickly. Now, I think you curate the news to find what's the murmurations in the wind. So what's your thought process behind that? Because that's fascinating to me.
So I didn't invent the term murmuration. Murmuration is a term from biology. So everybody's seen these videos where you see flocks of birds and they're flying and they move together and then all of a sudden they change direction, and it can be quite beautiful to see these birds. And people look at it and they say, well, I don't understand how the birds do that. What causes them to fly in those patterns? I've always thought of markets as complex adaptive systems. There's a lot of moving pieces. There's a lot of different players in the markets. There's a lot of different securities. They all interact in they all have initially simple rules that govern their performance, but the way in which all of these different entities and agents and objects interact can become rapidly quite complex. And sometimes, markets will move very smoothly. They'll just be a continuous kind of grind higher, like you saw maybe in the summer of '99, or even, the spring, summer of 2000, if we can look back that far. And then you have other times of profound instability where people are just kind of panicked. I was thinking about this today. The period, I think it was in 2014, right after Janet Yellen took over as the Fed chair, was remarkably unstable. I mean, it was volatile, but it wasn't a tradable volatility. It was almost like an unmanageable chop because people didn't know what to do. They were stuck in crowded, occasionally leveraged positions, and then they would have to sell the things that they could sell. So they were selling the most interesting, valuable positions, the ones you would think that would be the last one that they would sell, but those were the ones that they could sell, right? So in those kinds of conditions, you sell what you can sell. So murmuration is my attempt to grapple with this complexity in the markets. And so when you look at the way the scientists explain murmuration, you've got a flock of birds. You might have hundreds of birds. You can even have thousands of birds, I suppose. And they're all flying together. But from the perspective of an individual bird, they're only really aware of the birds in their immediate radius or their immediate proximity in 3 dimensions. What they do, though, is the moment they detect some sort of shift in direction or behavior from the birds around them, then the bird itself will react. And that's how you get these reversals in direction in the waves propagating through the flock of birds in a way that seems to me intuitively similar to what we see in markets, right? Everybody is very excited about something until they are absolutely not excited about that thing. And then they go running in the opposite direction. And, calling those turns and seeing what is changing at the periphery that ripples through the crowd is something that, if you can figure out how it works in markets, quite valuable, I think.
So, I guess what I'm curious about is what's the trigger for it? I remember we're contemporaries, and it used to be phones, and if you were you had hedge fund clients who would call up and say, "What are you hearing? What are you hearing? What are you hearing?" And there's one fellow that I know very well. He's a nice guy, so I'm going to change his name so as not to, in case he's watching. Let's call him Steven. And Steven was the perfect weather vane. He always knew the latest gossip. I don't know how many people he talked to. I guess it got easier once everybody got a Bloomberg or something. But what is the trigger? What is the medium now for that murmuration? I mean, I don't think the Bloomberg and the Bloomberg News or Reuters is quick enough. So how do you pick up that change? Is it Twitter or X, as they call it today? How do you sense that trend change?
That's a very interesting question, right? I was smiling when you said, what are you hearing? What are you hearing? Because I remember on that when I was in the hedge funds, people would tell me to do that. I just felt ridiculous doing that because A, I was exposing myself as somebody that didn't know what was happening and why, and B, I was exposing myself as reliant on this person to tell me, and it became almost a game of telephone. It literally a game of telephone where people are just exchanging hypotheses that may have been fantastic. You've got if you go back to this notion that we're in a complex adaptive system and there are people with different time horizons, people with different access to information. You've got retail investors at one end of the spectrum who are doing their own thing. And at the other end, presumably you have these hedge funds who are completely plugged in every possible way. I think that they all operate with different preferences, including different time horizons. So the most sensitive ones, presumably, should be the hedge funds and the individual market makers like the Citadels of the world, right? Because they are seeing all of the flow. When you're on the sell side, you see all the flow, right? And you must have had, like everybody else on the trading floor, what they call trader's ears, right? So you've got your phone, your handset with your push to talk on one side, but your ears can hear everything else. And you're listening for all that information, and all that information is going somewhere. It's going into your brain. So I think the reason why we would call the sell side to ask them what they hear is because they are most exposed to that flow, like in the Matrix when you see the stuff streaming down the screen. So the hedge funds have direct access to that flow. They have indirect access to that flow through the people that are most exposed in terms of the dealers. Now that the trading has become more electronic and devolved into the machines, maybe they don't have as clear a picture into that, and it's the machines that get the most sense. But if you think about what I said about time horizons, there's a fractal nature to these markets, right? So there's murmuration at the margins on an instant-to-instant basis. But for people that don't have access to all of that informational flow, they must, by necessity, have a longer time horizon. Otherwise, they're going to get chopped up with false signals. And so the picture should hopefully be easier to distill if you're looking at it with a different lens, a different perspective. And that's where being able to, my version of being exposed to the flow on the sell side is that I will throw myself into Twitter, whenever I'm taking a break from my day job, or if I'm traveling, I read, all the news kind of voraciously. And I think with time and experience, you can develop a way to curate that information so that you can, in the same way that you would be able to pick out the one piece of conversation that was interesting, right? Like so-and-so is buying, dollar yen at 2 p.m. in New York on a Thursday. Well, okay, that's interesting. Why are they coming in now with this kind of liquidity? That might have some marginal value when you put it in to a broader, kind of puzzle, and it's the missing piece that puts the picture together. If that makes any sense.
It makes sense that if you use X, I guess there's so much financial Twitter that, and so many folks who have 2 million subscribers and folks who have less, but might be really interesting. As a matter of fact, you inspired me to program AI to say, I want you to go to the top 20 financial Twitters in terms by number of subscribers. pick through them and send me a report every morning on what's hot and what's declining. So I guess that's something that
Ah,
you didn't. So
ah.
you inspired me to do that. I'm like, how does he do? How does he figure to
No,
do
no,
that?
but okay, you got to be careful though, right?
Mm.
So with social media, um, you can have a lot of followers, but not say anything really interesting. You can have a handful of followers, but be the most interesting man in, New York. What I'm really interested in is not so much the followers, but the quality of what they're saying. So it comes back to this notion of curation, right? I might follow a guy that has 100 followers, but if he says something interesting, one day out of five, I want to be there. I want to see that one comment, um, as opposed to somebody that has 100,000 followers because he's telling people what they want to hear.
Although you could argue that somebody with that many followers potentially has a lot more impact. If he says something,
That's right.
then maybe a bigger number of people will act on it.
What I thought you were going to say is if he has 100,000 followers and he has 100,000 followers because, Chan, you were correct, he's telling people what they want to hear. There's information in the message that he's telling people because it's what they want to hear. So that tells you what the crowd may be thinking.
I want to go back just a second. It's from we were on different sides of the table, I suppose, for a period of time. When you were on the buy side, I always thought the hedge funds had the best information and not the dealers because I'd only get it from my guy or a few contacts, but you got all the salespeople would call you in and feed you every last bit, hoping for a trade. So the grass is always a little bit greener.
It depends on the sell side bank, right? If you're at a sell side bank that has a lot of flow, right? If you're trading gold and you're at the Bank of Nova Scotia, that's great. You're the man.
Yeah.
If you're trading Nvidia at the Bank of Nova Scotia, do you have an advantage over Goldman Sachs? No, you do not. Right? I mean, like Goldman's going to see the flow, and Goldman will see the flow in everything because it's Jay Aaron, so they'll see the flow in gold too, right? So that's just the way that is. But the hedge funds, you can be kind of isolated, right? So you're talking to other hedge funds, you're talking to the sell side, and they're telling you what they want you to hear. They're giving you some aperture of access into their information flow, and you may be telling them things that you want them to know, right? I mean, it's the game that people play, I suppose. I tried not to talk to other people. I wanted to preserve my independence of mind. I didn't want other people to get in my head until I'd fully formed my view.
Then you're just piggybacking on somebody's ideas and not doing the work, basically. I want to. You're an expert in AI. I mean, you have and if you could briefly tell us what Sextant AI does, and then some things that you've written about, sort of the evolution of the AI trade. Like, where are we in the AI trade right now? Everybody's afraid. How is AI going to finance 7, 8, 9% in the long end? That's the sort of the flavor of the week, I think it feels like. But so what does Sextant do, and where are we in the AI trade?
All right, I caveat that by saying I don't think I'm an expert in AI the way some of the people in Silicon Valley are, but I think I've got a savvy sense of AI. So that's the way I would phrase it. So Sextant AI is a company that is building a verticalized AI application that will exploit a lot of the infrastructure that is being built currently, specifically in supply chain management technology. So supply chain management technology is used by every company, whether they realize it or not. Even if it's just email and spreadsheets for the smaller companies. But there are, many solution providers like Blue Yonder and O9 and SAP, ERP vendors like Oracle, and they will have technologies to do a variety of different things. These are SaaS technologies that are currently being either upgraded or replaced by AI versions for things like demand planning, inventory optimization, network optimization, forecasting generally. So for example, with inventory optimization, you want to have enough inventory if you're selling ice cream as a retailer so that you don't run out of ice cream when it's hot and people come in looking for ice cream. At the same time, you don't want to have too much ice cream because if it doesn't get hot enough, you're carrying this extra ice cream, which you have to finance with working capital, right? So there's an optimization that needs to take place, and there are sophisticated SaaS tools that are now being upgraded into AI tools. So if you look at those workflows, each one of those things that I just called out, like demand planning, is a workflow. Those workflows are well known and mathematically practical. People have been studying these for decades. What you're going to see is an autonomous execution of those workflows for the most part, where exceptions will then be surfaced for handling by humans in the loop. So the experts in the supply chain management team of company X will turn the machine on. They'll have parameterized these workflows and told them, here's what we're going to tolerate. Here's the nature of our organization and all that kind of thing. Then the agents will go to work. They'll do their work. And then when things look a little funky, they'll surface up this edge case, and then the team gets involved to fix it. But in order to do that, there's a big problem that people haven't really addressed. They say that they've addressed it, but we don't feel that they have. So every company has a data model, which is essentially a schema representing digitally, abstractly, that physical supply chain. So the logistics assets like their trucks and their warehouses, all of it, right? And the supply chain consists of three things: the flow of goods, the flow of money, and the flow of information. They'll buy a solution like an SAP or a Blue Yonder. That solution has its own data model, which is its abstract representation, right? So if you can think of it, O9 is speaking Greek, the company is speaking French. So in order to get the company to work with that solution they just bought, they have to plug them together. And that integration is typically done by very highly paid consultants for a ton of money, costs a lot of money. It often takes months, maybe years to do, and it doesn't actually get done perfectly. And even if it does get done perfectly, it's static. And those data models on either side are evolving over time as businesses change. So that semantic mapping takes place currently with human beings. They might have some software tools to help them do it. But it's a one-to-one kind of exercise. And even when they do the semantic mapping, then you've got data that may have some noise in it. So you need to cleanse it, pre-process it, and validate the data before you put it in the machine. So the first problem is that semantic mapping might be fraught or stale. The second problem is they may not execute that validation step properly or at all, so that when they throw it into the solution will put out results that are wrong, that has real financial and operational consequences for the business. The end users, who are the people, in the supply chain management team, will have a sense for what the answer should be. And if they get frustrated enough, they'll just stop using the system. And that all of these problems that I'm describing lead to massive implementation and systems failures. They'll just go back to doing whatever they did before. So what we are working on currently is a proprietary set of agents to do that semantic mapping on a dynamic daily basis, where they will understand the schema that the customer has, and they will understand the schema that the solution provider has, and they will also understand our canonical standardized data model. We insert our data model as a layer between the customer and everything else. So then we translate from the customer's French into our English language. We do the cleansing, pre-processing, and validation with a second army of agents once it's in English. We have our own proprietary workflows that the customer can use. Or if they say, well, we bought this SAP instance, we can plug into SAP, and then SAP does its work. It does its work in Greek. It then sends us back its results, which we translate back into English, and then we translate it back into French. But what we believe that there's a real network effect. Once we get multiple customers from the same supply chain or from the same industry with all of their data in the same English language, then we can have customers talking to one another using our lingua franca about supply chain stuff. So you could have companies that are all in the same supply chain talking to one another and sharing information with each other directly or indirectly. If they decide to share information indirectly because they don't want to, you know, show their partners or their customers their internal information, they can anonymize. We can anonymize the data and share it at a common layer, where, to use a Canadian phrase, Sextant then becomes the honest broker, and then we can start to distill intelligence from that data. So, for example, let's say that we had several hundred companies in the healthcare sector in 2019, and they had all been using our common English language, and they elected into this honest broker service. We wouldn't have known that there was a COVID epidemic brewing in China, but we would have been able to say there are strange things happening in Asian supply chains. And we will make recommendations to our agentic workflows and back to the customers to say, at least to flag this situation so that they can adjust faster and more efficiently. So that's the theory. And then we have a social network on top of that. So all the users within Sextant are connected to all of the other users, which means that we can expose potential commercial connections for greater diversification of supply chains and other kinds of enterprise sales.
That was a really interesting sort of slice of, I guess, how you can use AI. It makes me think of Palantir in some ways, but I'm a neophyte.
Okay, I have to address that. So we are essentially doing similar things to Palantir, right? Palantir sends their forward deployed engineers, and they will take the customer data model, and then they will map it into a digital twin. And then within the digital twin, they'll anonymize the data. And then once it's anonymized, then they will use AI, and they can do all kinds of simulation and work in the digital twin without touching the customer's actual data, that they then make recommendations back to the customer. We are different from Palantir, but similar in the sense that instead of having forward deployed engineers, or as many forward deployed engineers, we are trying to replace the forward deployed engineers with agentic workflow. And we'll have this digital twin, but it's in our lingua franca. So every digital twin that Palantir makes is idiosyncratic and specific to an individual customer. Our data model, our schema is the same across customers, which then enables all kinds of collaboration that Palantir doesn't contemplate and perhaps doesn't want to contemplate because they aren't necessarily interested in sharing data for a variety of reasons. Their customers may be larger and more focused on their proprietary intelligence. So it is very similar. I'm very happy and excited to hear you make that comparison. So thank you for that.
I'm just a neophyte. So, so given where we are, you have all these. You're going into the trading side, where our listeners and our viewers are really interested in. You have the hyperscalers, you have the neo clouds, you have the end users like the ServiceNows and the and similar folks like that. Where it's hard to keep track of. So, where do you see? I'm not sure that's the right way to say. Where do you see value, and where do you see places in the AI infrastructure that you might say, I want to be a little careful of this because this trade is getting a little long in the tooth. But you should be looking in a different area, given your background, your trading background, as well as your sort of AI CEO background. Where just a couple areas where you think that investors should pay attention to.
Yeah. So getting back to the murmuration concept, a large part of the driver for the murmuration and the movements in that flock of birds is going to be, in this case, the investment birds, is going to be narrative. And there's a saying, narrative follows price, right? So people will construct a narrative to explain the present moment based on the recent price history, looking back for some period of time, depending on the individual situation. So the way I would look at it is generally in any investment situation and say, okay, what is the current narrative? Where will the narrative be in 6 months to a year? What are the things that will cause the change for the narrative? And when what is the catalyst for that change, and what will then where will things fall out? Where will the price be? So that's the first thing. I think the second framework that I would kind of bolt onto this is to look at three or four dimensions of the investment activity. What is sentiment? What are the technicals? What are the fundamentals? And I think those are the big three. And then the narrative, I guess, would be the fourth. So with AI, I was at my business school reunion in the spring, and there was a speaker. I didn't see him, but people were very excited after this speaker. One of my friends who's a brilliant investor said, this guy came out and he said, it's great that we're putting all this infrastructure into place for AI. It's just like the telecoms bubble. People were criticizing all of this investment in the telecoms infrastructure, but look at what happened. We're using all of it and then some. We don't have enough now, and it's great. It was the right thing to do for the economy. Well, yes, except for the fact that all the people that invested in those things got flushed and had to sell to other people, like distressed guys who are buying it for pennies on the dollar, and had to wait a long time before a lot of that fiber stopped being dark, right? And what was the thing that ended up making it economic? It was downstream vertical applications, right? One of the big saviors of that infrastructure was Netflix. At one point, Netflix was the majority of internet traffic. Like the explosion of video and the technological advances in fiber transmission were necessary in order to make that happen. So I think a lot of people are looking at things like, the big infrastructure builds. So you pointed out like the big foundation models like Anthropic and OpenAI. They may very well end up being like those big telecom, providers, in the sense that they built out the infrastructure upon which lots of people will rely, but they may not be the beneficiaries of that. They risk becoming commodities. The cloud providers are, in a sense, one removed. They're almost like the telecom providers. So there's the risk that, yes, we do need a lot of extra data centers and cloud services, but then we can over invest in that and end up with excess capacity. And you see, and particularly if it's funded with debt, we could end up spinning into some sort of debt deflationary environment, at least for certain types of goods and services. So I really do think, and this comes back to Sextant, the bet that I'm making is that it's going to be these vertical applications that are built from scratch. Even, the SaaS applications that are in jeopardy here, they're all scrambling in every vertical to throw on some AI gloss, right? So they'll say, oh, we have agents and we have this and we have that. But the underlying architecture is still the SaaS architecture because they have tremendous sunk costs into that approach. And so they're just kind of wrapping AI around it. It's going to be entirely different to see applications that are built from the ground up with an AI perspective. So I think the way this will play out is, my operating hypothesis is that as people become aware of AI, they're going to go into the infrastructure providers first, then they'll go into the things that are the next proximate downstream incarnation of that, like the neo clouds, for example. And then they'll eventually end up in these applications that are AI native. That's my theory.
If what sector of the AI trade would you say you're perhaps most leery about, and where do you think maybe it's emerging and this is a place that investors should do some real investigation? There might be some opportunities.
Well, fortunately, I don't have the kind of access to the foundation models, so I couldn't get myself into trouble by investing in them. And there are people that have made Croesus-like returns in investing in those at the right time, and even recently, presumably. But if I think it's just a question of pacing it. There is a point now where infrastructure and certain types of semiconductors are very, very interesting. They are capacity constrained. I started out right after 9/11 in hedge funds. Nobody wanted to touch technology because the bubble had burst. So as the new man in the group, I got the things that nobody senior wanted to touch. So I was looking at airlines and TMT, basically technology, not the media so much. And you see these wicked cycles that ironically are connected to supply chain irrationality. There's something called the whiplash effect or the beer game effect. And you would see this constantly, and you haven't seen it in semiconductors in a very, very long time because the demand is so overwhelming. So I think the right place to be right now is in the places that are kind of downstream from the foundation models. Not that anybody without extraordinary access to those private deals can play anyway, but would be in those things like cloud computing and certain types of semiconductors and technology, depending on the specific nature of the supply demand characteristics within that group. But even then, you got to be very, very careful because of the extreme murmuration there, right? So if everybody can see this, and everybody has like a consistent hypothesis, and people start to leverage up and they start to plow into these names, and the murmuration becomes very skittish in my terminology. And you saw that in July when that hedge fund with the brilliant chap blew itself up.
Right.
Because he got over his skis. He was investing in public equities with leverage, right? So on swaps, so let's call it 3 to 4 times leverage, let's assume. And he was telling the entire world how big he was and how levered he was. And it was only a matter of time before the hedge funds ganged up on him. I mean,
Yeah.
Ken Griffin he's just bragging about it at this point, and good for him.
Yeah, he's 26 years old and not really a trader. I do have a question for you, and you perhaps know this space better than I do. Nobody has written, how does Citadel get like a 10% discount unlisted?
Well, I think what ended up happening was so it was the leverage. So let's this is my assumption. I don't know anything. I'm just looking at it from the cheap seats, right? So this guy, who by all accounts is a brilliant guy and is still up a colossal amount of money, right? Year to date, he has access to all of these deals that nobody can get into. He has made a colossal amount of money for his investors, despite having such the huge loss. He's already made more than most people will ever imagine making in their lifetime. So I'm not trying to beat up on him, but I think what happened was his leverage was via swap with banks, right? So prime brokers. And they're more than happy to give you the leverage. Oh yeah, here's the money. Go after it. And he's going out and he buys all these positions and he tells the world in his newsletter, which is part of his fundraising and his reputation, oh, I just bought all this stuff, right? And everybody knows he's unleveraged. So the moment that somebody can motivate the flock to start flying the other way aggressively, the banks start to get a little nervous. They're not in the business of losing money. So they tap him on the shoulder for a collateral call. And all the banks are tapping him on the shoulder for a collateral call at the same time. So if you want to stay in these bets, you're going to have to give us more cash, basically. And so he's scrambling for cash. He's scrambling for cash. And as the word ripples out that or people can feel it, right? The birds in the flock can sense the fear spreading through the flock. It starts to accelerate to the downside, which then compounds his problem. And at some point, the banks have to say, okay, if you can't give us the collateral, we're going to have to sell you out of your positions. So either individual banks or a consortium of the prime brokers who were exposed to this guy, who must have been sharing with one another their exposure to him as part of their credit due diligence on him. There must have been my guess is that a consortium of banks executed an auction where they called up a handful of players that were large enough, and Citadel's hedge fund was one of them, to say, okay, we're going to auction off a $10 billion or whatever it is portfolio. And we may or may not be able to tell you exactly what's in the portfolio, but here are the characteristics of the portfolio, and you can decide whether or not you want to submit a bid. Because they're not telling them exactly what's in the portfolio, and they're just saying, here are the attributes of the portfolio, there's some risk to the person that's submitting a bid. So if they knew with perfect certainty the constituents of the portfolio, they would say, okay, that portfolio at this moment in time is worth 62 cents. So I will bid 62 cents. But because they're told this is the portfolio that behaves like this, you think, well, if I think it might be worth 62 cents, but I'm not sure, so I'm going to bid 50 cents.
Right. So I guess what nobody has written about is it sounds as if the banks were calling around saying we need to auction this off, and it wasn't so much situational awareness asking for would you take this off me. It was really a consortium of the banks doing this. I see.
I think I read somewhere. Sorry to interrupt. He was trying to sell off some of his private investments to come up with the cash call, right? And he couldn't come up with the cash soon enough, or he was convinced, don't sell off the golden goose,
right,
to double down on this, because even if he had done that, the attacks would have continued, right? So there's a joke, there's a saying that they used to have in the Vietnam era army: the beatings will continue until morale improves, right? And so I think that's what would have happened.
Oh, that's really helpful, and nobody has written about that.
I've seen, but this is my guess, right? It's completely from the cheap seats. Take it for what it's worth.
I'm going to guess it's a pretty good guess. I want to move on to a couple other things that I've kept you on for a long time already. I'm just going to use Costco because I talked about Costco today. For someone who says, someone says, this stock looks interesting. Costco's getting apparently starting to sell Medicare Advantage plans, which I think is absolutely brilliant on their part. So how do you look at Costco trading at $970 a share, right? Just as purely as an example, their forward PE is in the 40s. That feels kind of high. So is that the right way to look at it? Their forward PEs versus their peers, whereas, you see SK Hynix forward PE is like 6 and they make a gazillion dollars. How do you tell if you're a novice investor, like what's value and what is not value?
That is the big question. I think if you take a step back, right, and you go to first principles, when you look at a company as a potential investment, as an equity company, or even as a credit, you say, okay, this company is a combination. It's a bundle of assets. It's got human capital, it's got financial capital, and it's got intellectual property. Their job is to convert that bundle into something that produces cash or increases the value of that bundle, or both, going forward. So when you're doing a valuation of a company, you're really trying to approach it from that lens. A discounted cash flow is a projection of, the financial statements in a particular way, which is the reflection of one particular set of assumptions. Could be a detailed set of assumptions for how they convert that bundle of capital into the future, right? Whether it gets bigger or it gets smaller, and then specifically to look at the free cash flow that falls out of those projections of financial statements that you then discount at some reasonable cost of capital to come up with a net present value. The problem is we live in a completely uncertain world, right? 5 years ago, I was talking to people about AI. Nobody wanted to talk about AI. It was just crypto, crypto, crypto. AI's dead, dude. AI was hot until it was dead in 2022 or whatever. Then everybody was focused on crypto. And, good for you, Chan, talking about AI, but, we're all focused on crypto, right? So there's a tremendous amount of uncertainty, particularly with companies like SK Hynix. SK Hynix has, a binary tree with myriad paths that it could follow. Because not only do you have how good is the management team? How good is their intellectual property? How well capitalized are they? But you layer on top of that all of the uncertainty in the markets in which they deal, right? We could have something cataclysmic could happen in the semiconductor space, right? I can't even imagine what it is, but let's say, an asteroid hits the semiconductor market. Um, all of a sudden they're going to be trading at the low end of that binary tree. Or if everything's great, they could be at the high end of the binary tree. Like there are many, many paths. So if you're valuing options, there's a binary model for valuing options where you would have these different paths and then you would discount them back through the tree based on whether or not they got exercised to maturity, back to the present moment, right? So that's called real options analysis. And then when you see PE multiples or EV to EBITDA multiples, that's just a snapshot that's trying to summarize that discounted cash flow or that real options analysis. So when you say Costco has a PE of 40, you're saying there's not a lot of volatility around their results. Their business is very stable. And we have tremendous faith in the management of that company to convert their financial capital and their intellectual property into growing the pie going forward in one way or the other, right? And their customers are fantastically loyal. Try going to a Costco on a Sunday. It's a food fight, literally, right? I mean, you got to watch your ankles. So that's why they get traded the way that they do. And SK Hynix has a lot of uncertainty in their model that has nothing to do with them. That has to do with the market in which they exist. But the reason why they're such an attractive company is because they've done fantastic things with their physical plant and their intellectual property. When you look at things like high bandwidth memory, I mean, that is just a beautiful company.
It's actually a really good insight in terms of look at the PEs through the lens of volatility. You can have a higher one if your volatility is relatively low, but if your volatility is high, then it should be lower. With the exception of Tesla, that's a whole different.
But Tesla, okay, but if you look at my thing about like that bundle of human capital, physical capital, and intellectual property, there is an outsized premium placed on Elon Musk and the team that he has assembled, right? So his intellectual property may or may not be that good. His physical plant may or may not be that good, but people believe in him and the team that he will keep. Right. So let's assume that he's a very good manager. He attracts really smart people. He weeds out the people that are lazy or not as smart as they actually turn out to be. Right. And he assembles the best possible team. That's why Tesla trades the way it does. It trades the way based on his intellectual promise. The moment he dies, whether it's tomorrow or 40 years from now,
He's Mr. Positive Gamma. He's your massive positive wingnut gamma. I'll have to explain to my viewers.
You know what?
Look
It's
that
like.
one up.
I was trying to explain this to my children, right? It's like the way people look at sports teams. There are guys I know, they don't know anything about equities or anything. They give their money to their wealth management guy and, number goes up and everybody's happy. They can tell you everything there is to know about collegiate football. They know who's going to win. They know who's not going to win. But even then, you get upsets in collegiate football, right? But they are looking at the teams like nobody would have picked Indiana University. My daughter just graduated from Indiana. Nobody would have picked Indiana to win a couple of years ago. I remember going to games from choosing freshman year.
They play basketball, man. They don't play football.
Yeah, that's a basketball school. And even then, the basketball team sucked. It still sucks. Now, but the football team, they bring in a new coach. This is a great example of this bundling theory. They bring in a new coach. He brings in a bunch of players who follow him. He's got a system for doing things, and they make things happen. I mean, Signetti is a genius at what he does, right? So I think the cyclicality and the unpredictability of the SK Hynix business will make valuation based on multiples less relevant there. You have to think about what the next season is going to look like because the semiconductor cycles have traditionally been so short and so volatile.
A question, back to your putting your trading hat back on again. Trend following versus contrarianism. Sometimes trend following seems to be, sort of the easiest way to do it. It's sort of not sexy. You're following a trend, but being a contrarian, well, like that's kind of hard. How do you're going to say that everybody else is wrong and I'm right, or a small group of us are right? How do you, for the investor who has a day job but is trying to, make a go of it, what's the easy way to go? What's the better way to go, I suppose?
Well, let's go back to that three-pronged framework: sentiment, fundamentals, and technicals, right? Trend following is most of the time, I think, a sensible way to go, right? The crowd is smarter than people think. Contrarianism has the sex appeal of, if you get it right, you're the man, right? Particularly if you told people in advance, and then
people have made careers doing that.
Oh yeah, yeah. I mean, there was a woman who called the '87 crash. I think Elaine Garzarelli.
That's right. She made her career on it.
She raised assets like she was in E.F. Hutton, so she was kind of like at Lehman. She raised lots of assets. She never came close to doing anything good performance-wise, but people gave her money because she was Elaine Garzarelli. There's a college in Massachusetts named after a guy that called the '29 crash. He also called 10 crashes that didn't happen before that, but people remember that he called the '29 crash. So there's a sex appeal in being contrarian. So being contrarian for the sake of being contrarian is wrong. I think the contrarianism has worked for me when I can't reconcile the price action and the prevailing market narrative with other signals that I see from the fundamentals and the technicals. If I see those kinds of divergences, at a minimum, I will just get flat in whatever name it is. But if I see that divergence persisting, then I might put up a small amount of money on betting against the prevailing trend, with the view to really piling in if the turn comes, because people are so exposed and over their skis. And when the turns can be quite violent, right? I mean, look at some of the turns that you've seen in the highly leveraged names, like even IGV, for example, that software ticker. So contrarianism is intellectually appealing. I think for me, I prefer to be a trend follower, and then I'm only contrarian if the divergence is so strong that I can't ignore it.
I want your insight on this as well. I spoke to somebody I work with. He's a terrific analyst with Bloomberg now. I'll keep his name out of it. He used to run as much as $1 billion in discretionary, levered. But he says, nobody wants discretionary now. And if you look at job listings, everybody wants systematic. They want a program. They want something ideally repeatable, taught by a trader. So if that is true, and it is so much more systematic than it is discretionary, how does that change murmuration? Is it the machines pick up on signals rather than humans pick up on signals? So it's really. I think.
Yeah.
Sorry,
I think
go
that's
ahead.
what it is. I think that's exactly what it is, right? And so, we talked about Twitter as being some sort of indicator for the murmuration. People are using all kinds of machine learning and AI on the Twitter stuff, right? They're using it on the news flow. So the thing about I think systematic that's appealing to people is that at least they can sleep at night. They can understand the rationale. It's not like the Wizard of Oz is producing a card and just saying, okay, today we're going to go long. So, and we can have fun with numbers and prove statistically a systematic approach or a quantitative approach is better or worse. But many of the discretionary approaches were more systematic than they might want to admit, particularly with a longer term time horizon. They were still driven by fundamentals. They would screen for candidates in a systematic way, right? So part of it's marketing, I think. It's just our mutual friend Jared Dillian. If you want to really get him excited, ask him what he thinks about indexing and passive investing. Right? He'll go to town, and arguably, passive investing has distorted markets tremendously. Right? He wrote this thing last week where he said people believe that passive investing into an S&P 500 fund,
He's safe.
index fund,
He's
is
the
safe.
he's the second guy I read every day after you.
Yeah, yeah. But I mean, it's 100% correct. You're piling into equities, right? Which have been notoriously volatile if you look back over the last 100 years, with big drawdowns potentially. And long fallow periods where it's been difficult to recover from those drawdowns. That's not safe. It's what you have done is you've reduced costs, right? And so you can make that case that systematic investing is probably cheaper in terms of the execution. But and the systematic guys are essentially trying to distill the judgment from the best active or discretionary guys, right? You could make that argument that it's a cheaper manifestation of discretionary judgment. But if David Tepper, ever said, you can invest with me, and I had enough money that I could do that, then I would do that and go to sleep very well at night. I mean, there are discretionary guys, and then there are discretionary guys.
Question about you mentioned technical analysis a couple of times, and I've always thought as technical analysis that sort of effective because it tracks almost human emotion. And you can see things are oversold, overbought, different signals, many different ways of looking at it. If so much is now systematic or machine driven, does that make, no matter, like, despite who may have actually taught the machine the rules, does that make those signals less valid than they were 20 years ago before, it was really machine where humans actually executed and not, you tell the machine, I need to buy 50,000 units, do it in an hour, and the machine chops it up for you.
Yeah, well, those are two separate things, right? So there's systematic investing, and then there's the quantitative trading. So the quantitative trading is, you can almost think of it as AI execution. So let's set that aside. Their time horizons are so small that it's not particularly relevant to the individual investor. But if you look at technical analysis, that is a subset of a broader approach of filtering all of this information that's coming out of markets in terms of prices. Quantitative investing, writ large, is coming up with new filters for different types of, coming up with new filters potentially based on novel sources of information in order to distill a signal that's actionable from an investment perspective. Technical analysis was just the simplest filter, and that's why it was so pervasive for so long. You could make the case that all these other filters have displaced technical analysis, but I suspect that technical analysis is the substrate underneath most of these quantitative systems. I have no proof of that. I've never worked in a quantitative fund, but I'm sure that they kind of all look at some version of technical analysis. The 200-day moving average is the most primitive filter you can imagine for saying this looks good or this doesn't look good, right? But if you had a systematic approach, a quantitative investment approach, you've got hundreds of these filters. And the issue with the filters, just as with technical analysis, there are some technical signals that work well in particular conditions, and then they won't work well in other conditions. The same thing happens with the quantitative funds. They will come up with their different proprietary signals, and they'll work until they don't work. They might work well, in this kind of environment, but because everything is so complex, the interaction of like 17 moving pieces that we can't see will then render them less useful, or everybody figures out that same signal and then starts using that signal, and then it becomes less relevant. My sense intuitively is that the technical signals are robust to that for whatever reason. But I just use them to filter investment opportunities so that I can see how the shape of the flock is changing,
Right.
the multidimensional flock.
Now, trying to get away from that last question, the trying to get away from the immediate murmurations as we head into into the second half of second half of this year, well into second half of this year, for the rest of the year or so. Any macro ideas and outlooks that really strike you that you think are maybe the crowd is missing, or something you feel strongly about that people should pay attention to?
Well, I've been wrong about the Treasury curve. I was right in the short end, but I didn't anticipate the steepening in the long end. I was bullish on Treasuries because I thought inflation's overdone. We're looking at these lagging indicators. The more forward-looking or contemporary indicators suggest that inflation is coming down, that we're going to enter into a disinflationary regime, or we'll get back to some semblance of closer to 2%. The steepening in the back end, I think, is a function generally of the demand for funds from governments and now from private players in AI, and it doesn't seem to have any limitation. There doesn't seem to be anybody in Washington or Ottawa or the UK or anywhere else that seems to think considering trade-offs is a good thing when it comes to expenditure. There's always more money in the banana stand, seems to be our approach to fiscal management, and that's leaking into the backup in the long end, which for now is okay because we are managing all of the big part of the debt in the short end, at least in the United States. So I'm watching that, and I think it's fascinating to see real yields where they are. That's probably this thing in the back end, though, suggests that commodities, and particularly precious metals, are very attractive as an alternative. It's interesting to me to see precious metals going up as rates go up. That's not the conventional wisdom when it comes to precious metals. So I think when you see, and then you combine that with what's going on in China, which is a black box from my perspective, but there are some weird things happening there. Investors there don't have a lot of options. So I can see gold being one avenue for them to hide. And they're running out of places to hide. Every place that they turn to hide ends up not looking like such a great place after, a not long period of time. And so I find commodities very interesting, find real yields interesting. We may be at some sort of tipping point. The election, nobody seems to be talking about the midterm elections here and what that could mean for markets. I'm kind of tired about talking about Iran. Everybody talks about Iran. It's like, okay, great. It's shocking to me that the price of oil has not gone up higher than it did at its peak after the commencement of hostilities there. I do think that there's like an asymmetric trade there to be had, where if oil goes down, it's got a natural support, probably, I don't know, $70, $80 a barrel in terms of WTI, because people will be looking to replenish their coffers. And so there's the possibility of some sort of spike to the upside. But the economy seems to be doing okay from a growth perspective. Let's assume that my assumptions about inflation coming down in a disinflationary regime are okay. You might think that should be very positive for value, including for small and mid cap value, because if they've got pricing power and they have some sort of edge to their business, then that economic growth would sustain them, and they've been out of favor for a long time, as people have been over the last few years anyway, using them as a funding trade to get into these higher octane technology trades. And the flip side of that coin is that there may be some movement in the technology trade towards more of these application specific opportunities. But these narrative shifts will all come at different points in time.
Great.
Those are the things I'm kind of looking at.
Well, thank you so much for spending so much time with us today. Look forward to having you on the show again. Really appreciate it.